Over the past 12 months, the stock market has rallied by a significant amount. The main supporter behind this uptrend was the Federal Reserve backed by Jerome Powell. The Federal Reserve has been printing a significant amount of money through policies such as low interest rates and quantitative easing. And while interest rates will continue being low in the near future, they are bound to increase eventually. Once this happens, the stock market will likely crash, as the primary driver for the bull market is no longer there. One investor, Cathie Wood, the CEO and CIO of ARK Invest, has actually predicted the crash that I'm talking about. Knowing this, he has a unique strategy to combat this possible stock market correction. In this video, I'm going to go over why Cathie is predicting a valuation reset and what you should do to prepare. Welcome to Casgain's Academy. If you're new to the channel, please consider subscribing for more content like this, and let's get right into it. As I mentioned earlier, the Federal Reserve cannot keep interest rates low forever, and rates are bound to go up eventually. The stock market is all about predictions for the future, so it's natural for the market to correct before rates actually go up. Cathie Wood predicted that this correction will impact certain stocks more than others, and it just happens that her own ETF is one of the prime candidates. Over the past few years, Cathie's 5 ETFs have all gone up by a significant amount, with 2020 being her most impressive year. Because of this, Cathie Wood actually said that her ETFs are likely going to be heavily impacted by correction. Yet, that doesn't mean you should sell all of your innovation-related stocks. Cathie's strategy is what we'll go over soon.
It seems undeniable to me, though, that you must be thinking about the impact of higher rates on the kinds of stocks that have been tried and true winners for you all throughout, whether it's the Signature Fund, the FinTech Innovation Fund, and even other areas of the ETFs that you have. Are you worried that as rates go up, those stocks could come down?
Well, I do believe if rates were to take a sharp turn up, that we would see a valuation reset, and our portfolios would be prime candidates for that valuation reset, of course. Now, one of the things that I've found interesting over the last really 20 years is that the S&P's PE ratio tends to peak out in the 20 to 25 times range of the forward earnings.
The stat that Cathie Wood just mentioned was the S&P 500 forward PE ratio, which is the expected PE ratio for the S&P 500 in the next 12 months. As Cathie mentioned, the S&P 500's forward PE ratio usually peaks out at 20 to 25. The current estimate for the S&P 500's forward PE ratio by the fourth quarter of 2021 is 25. Because of that, Cathie Wood is implying that a stock market correction is going to happen. Now that we know that, you might be wondering, how can we use this knowledge to our benefit?
I agree with you, Scott. There will be a valuation reset. There will be fear, I'm sure, and we will use it to our benefit, concentrating our portfolio to our highest conviction names. But I think longer term, especially given the powerful growth trajectories that the 5 innovation platforms around which we revolve all of our research, that those trajectories are so powerful that these multiples, these companies are going to grow into their multiples a lot faster than most investors are now expecting. And so that's a source of confidence for us.
What Cathie just said is extremely important. While a stock market crash is bound to happen, there's no need to be scared about it. In fact, a stock market crash is a rare opportunity to go all in on your high conviction stocks. That means selling out of lower conviction stocks and buying into the stocks that you have the most confidence in. The other point that Cathie makes here is key to understanding her long-term vision. Valuations are definitely high at the moment. After all, if you take a look at the price to sales and PE ratios of stocks in today's market, you can clearly see that many are extended to very high points. Nevertheless, if you think that a business is going to grow extremely fast in the next decade, then why would you bother selling that stock? Eventually, if that business continues growing at a fast rate over multiple years, its price to sales ratio and PE ratio will come down to normal valuations. According to Cathie Wood, those are the types of companies that you should invest in. Companies that are going to grow by a substantial amount. By that, I am talking about companies that are going to grow so fast that their current multiples will come down significantly in the future. Some of you might be wondering whether you should sell some of your stocks right now. After all, if a correction is bound to happen, then why not sell now and buy later? This is where Cathie Wood's unique strategy comes into play.
So my question plays off what Scott just asked you. Do you take into account, or do you have any type of forecast in terms of rates and adjust the portfolio to that forecast? or do you keep cash there? And ETFs are kind of interesting in terms of the level of cash you're allowed to keep or not keep. So how do you do it? So rates right now, they're moving up. Do you say, okay, we may be in a little trouble here with this valuation reset. They're going to jump up another whatever up to, maybe 2%. Do you get in front of it, or do you just take it as it comes?
No, we use it actually. And so what we've been doing for the last 6 months is expanding the number of names in our portfolio. And we do that as a bull market extends, because in some ways it's a tax efficient strategy. What we will do during a correction, especially a severe correction like the crisis presented, we will sell names in which are creating losses now, because again, we've bought them, we've diversified and bought them more recently. Sell those names creating losses to buy our highest conviction names. Some of the names we've been moving into, you'll notice, are names like some of the bigger biotech names, Regeneron, Novartis, Takeda. And what we will do and we think of them as cash-like, but there's also an investment reason we are moving into them. Ironically, we think they're deep value names because these companies, the ones we are choosing, they are able to use the convergence of technologies that is taking place today in the genomic revolution. So DNA sequencing, artificial intelligence, once again, and gene therapies, new technologies, new ways of doing things.
The strategy that Cathie Wood is talking about is somewhat unconventional. Instead of selling stocks to hoard cash right now, Cathie Wood is buying into what she calls cash-like stocks. These are stocks that are currently undervalued and won't go much lower in a stock market correction. The strategy is to purchase these cash-like stocks right now, and if a correction happens, then you would sell these cash-like stocks to purchase high-growth stocks. Cathie called these stocks deep value stocks, and it's for a reason. The three names she mentioned, Regeneron, Novartis, and Takeda, are all undervalued by their stock ratios. If we take a look at Regeneron, it has a forward PDE ratio of 10. Additionally, Novartis has a forward PDE ratio of 14, and Takeda has a forward PDE of just 9. These are very low valuations, especially in a bull market like today, yet they are at a discount for a reason. These stocks aren't growth stocks like Tesla and Amazon. At the same time, these companies aren't dying companies like Nokia or Blockbuster. These stocks are ones that are expected to grow at a relatively slow and stable rate. In fact, some are not growing at all. Takeda is expected to have its revenue decline by 1.2% in 2021 and 0.1% in 2022. Because of these relatively stable rates of earnings and revenue, these companies serve as great cash substitutes. The reason why you should invest in these instead of holding cash is because of the win-win situation they provide. The two situations are that the market continues going up and that the market crashes. The first situation is that the bull market continues. While we can almost be sure that a stock market correction is coming, we don't know when it will happen. If the bull market continues, these stocks won't fall much. In fact, they might not even fall at all. Cathie actually has a strong case for why these stocks will increase in value over the next few years, and we'll soon go over that. In the first situation, the bull market will only continue if the Federal Reserve continues printing money. In that case, inflation is bound to happen, and these companies are a great hedge against inflation. If you hold cash, the Federal Reserve will just continue printing money and the dollar will lose value. If you hold these deep value stocks, then you will be protected against inflation, because these companies are selling products that are immune to inflation. The second situation is that the stock market crashes. In this case, these deep value stocks won't be hurt as much. The stocks that will be hurt the most are those that have already gone up significantly in value. Stocks like Tesla, Square, and Roku will likely go down the most in a stock market crash, as they are more volatile. In the bearish scenario, after the market crashes, you can sell these deep value stocks and purchase stocks like Tesla, Square, and Roku at a discount. That way, you won't lose much money on the deep value stocks, and you'll be able to purchase your high conviction stocks at a discount. As we can see in both scenarios, the deep value stocks serve a fantastic purpose. Now, let's get into why Cathie sees these deep value stocks increasing in value over the next few years.
They are investing aggressively now. They have to, because they've lost a lot of their pipelines or will soon do so. And we think the returns on investment in the biotech space, and I'm talking big biotechs, if they're doing this correctly, could move from the high single digits today back into the golden age of healthcare. So in the 80s, we saw 20 to 30%. So we're using them as cash-like instruments in some way, because we will move back into our pure play names if we get into a severe correction. But we also see the investment merit in these names. They're just not pure play names. So we use corrections toggling back and forth. And so right now, our flagship portfolio has roughly 52 names in it. At the low point in the coronavirus last year, it was as low as 33, I believe.
As Cathie mentioned, the deep value stocks aren't just slow-growing stocks. Large biotech names like Regeneron and Takeda are looking to innovate in the way they serve their patients. If these innovations are successful, then their market share could increase by 3 or 4 times. If their innovations fail and the stock market crashes, then Cathie will just sell all of these big-name biotech stocks and purchase her high-conviction stocks. In my opinion, this is a pretty clever strategy. It gives you the opportunity to make high returns if these biotech firms can innovate with new products and services. But it also provides downside protection in case the overall stock market falls. However, I don't believe in selling the majority of your high conviction stocks even at these valuations. By the way, my Patreon is now open with limited slots. By joining, you will obtain access to my full stock portfolio, exclusive buy and sell alerts, valuation spreadsheets, and more. If you're interested or if you're just curious, check out my Patreon in the description below. If you enjoyed this video, please hit the like button and don't forget to subscribe, and I'll see you in the next one.